Hello guys, welcome to this episode, of course episode 3 of Finance Talk series. Now in this episode I'm going to address one of the concerns which really touched me when someone was trying to argue. It was actually a business consultant who was trying to help a client, and I was so touched because the kind of advice this person was giving a client was a bit going to lead the client into a hole. It was a misleading statement. So I would wish to take this opportunity to really address this, so that maybe for those who will have the opportunity to meet this, you will be able to know how to go about this. Now the concern was about this person was trying to tell clients. I've not even mentioned my name. Of course, this is Efe Juma. Joy.
Yes.
How are you?
I'm good.
This thing really touched me such that I even forgot to maybe introduce ourselves.
Understood.
Maybe for the first timers, huh?
Yeah.
But it's okay. So, like I'm saying, there was a client who there's a consultant who was giving was advising people on a certain matter when it comes to LLC, that is limited liability companies, when it comes to tax avoidance, and to the way he was trying to talk, he was trying to put it as a tax avoidance, but it was coming out as a tax evasion. And in the context of Kenya, you see, tax evasion is illegal act because you are evading tax.
Yeah. And
it's our responsibility as a country or as citizens to comply with tax laws, or to contribute to tax.
Yeah.
Contribute to or pay taxes, so that, because the taxes are the ones that are being used to generate what we call government
revenue
or public revenue, right? Yes. So I have to address this because I don't want to see a case whereby somebody is using information which is not accurate. Now the case was this person was advising people that he was actually trying to draw a distinction between, for example, do you know forms of businesses? For example, we have sole proprietorship. You can have a sole proprietorship, partnership, and also private limited companies and public limited companies.
Yeah.
And other partnership usually have two types of partnership. We have limited liability partnership, and also we have unlimited liability partnership, right?
Yeah.
So where we for unlimited liability partnerships and sole proprietorship, there is no distinction between the business and the owner.
Yeah.
Right? The owner and the business is usually the same person. And actually they even share tax registration or KRA PIN for the context of Kenya.
Okay.
That tax registration is usually one, right? If you have a sole proprietorship, you don't need to register your business or register for have another tax registration or PIN for the business, right? They usually use one. So this person was kind of trying to advise people on advantages of registering LLC, limited liability company, right? So because of that separation, because when you register a limited liability company, there's a separation between the owners or the promoters, all right? The promoters, which means the owner, the people who initiated or created the company or registered the company, and the company itself, usually two people, right? So he was trying to say that he was saying that, you see, you can always capture some of the personal expenses under company. For example, you travel outside for personal businesses, for your personal business or your personal initiatives, then you instead of meeting the obligation, you pass your business KRA pin, okay, through ETR, right? So that it appear as the company is the one which whatever the cost you incurred there, it appears that it's a company expense. You understand?
Yes.
So it means at the end of the year, when you'll be filing returns, you will deduct all the expenses. So even that expense, the whatever you did outside, like the expenses that you incurred in your travel or in a hotel accommodation, it will be passed through the expenses of that company. So what does that mean? It means that that one will have an effect of reducing the profit for that company.
True.
And when profit is reduced, it means that the company will pay less tax. You understand? So in short, you've reduced tax with including some of the personal expenses into the company expenses. And he was trying to say, you see, that one is it's just a way you can avoid tax, but it's legal. I want to put it straight that it is not legal. It is illegal act, because it brings an element of tax evasion. Now I want to explain into details this scenario. The only expenses that qualify as a deductible expense under Tax Act is usually the expenses that are incurred or that are directly attributed or attributable to the revenue generated by the company. So it means anything or any expense that was meant or that was done or that was incurred that are not directly attributed to the revenue generated cannot be allowed or cannot be deducted from as a cost of production in that particular financial year. So when you take the advice that this person was trying to give, you are going to put your business at a very high risk, because first of all, when auditors go through the books of that particular company, they will be able to see that and they will flag it. And when they flag that, it means that you will incur some penalties, and also you will be obligated to pay the tax that you are trying to avoid.
But my question is, you do get that there are people who go for business trips, genuine business trips. So how will that affect the company?
So for genuine one, if it is a genuine business trip, there's no problem.
Okay.
It is become cost of company.
Okay.
So because if it's a business trip, then it means the revenue that will be generated by company, it is a part of cost to revenue generated by the company. So for business, if it is a business trip, there's no problem.
Okay.
It becomes correct. Yeah, there's no problem. The problem comes when now it's a personal, but you're putting it for business.
Okay.
You understand?
And you're using the company's money.
Yes.
Okay.
Actually, it was paid for company money. So at times you find that such a person, because I've said that when you raise the transaction, or when you register that, or when you use your PIN, the PIN for company, or when you pass that through ATR, that is, do you know ATR? Electronic tax register.
Yeah.
Yes. So when you pass that, some people, for that case, if someone does that, then follow up by claiming for input VAT, right? So even that input VAT will be invalid. right? So when it is realized, then it means that you will also be penalized for that. So I want to put it very, very well that for personal expenses that you incurred and are not deductible expenses. Yes. So always ensure that nobody should lie to you that you just go and incur personal expenses and then put it for business, so that you reduce the reduce the net profit profit before tax. You reduce profit before tax, so that when you calculate tax on that profit before tax or earning before tax, then it becomes you pay less tax. I think that one will cause you problem. Yeah. So one of the things that we need to do as business people, business owners, always ensure that you be integral. Yeah. Always be integral in business. Business that are integral, or business that are compliant, are the business that operate for longer periods or for longer years, or periods that business that really survive for longer years. So if you start going through the corners, that one will in the long run will just make your business to go down, because when you start going through litigation, maybe the government or KRA sues you for having evaded tax, then those, of course, when you're penalized for such, it might strain your company, right? So it might strain that business, and you might find yourself going down, right? Or winding up the business. So it's very important to always understand these things, and don't usually just take advice at face value. Always ensure that you look at whom you take advice from, and try to do more due diligence before you decide on something. Yeah. So information is power. Always try to understand what you are doing, and where necessary, try to involve the services of tax practitioners who are qualified and know what they are doing, or business consultants or financial advisors who knows what they are doing. Yeah. So somebody might also ask. There's a statement I sent to you there. So can you just read tax implication with regard to the same?
Okay. Tax implications. Non-deductible expenses. Says, should I just read it?
Yeah, just read that one.
Since the travel was personal and not business related, the Kenya Revenue Authority, in the case of Kenya, KRA, may disallow the expense if flagged during an audit. This means the company cannot claim it as a deductible business expense when calculating taxable income. Possible VAT issues. VAT is value added tax. If the company claims input VAT on this transaction, Kenya Revenue Authority might classify it as an invalid claim, leading to penalties and back taxes if audited.
Yeah. So that's how that's the tax implication if you do that. If you have personal expenditure, then you push it back to the company. Yeah. With an aim of reducing net profit at the end of the financial year, so that you pay less tax. So if you do that, those are the implications. And also you've understood that also when you claim input VAT, it will not be allowed, and when audited and found that you did such a thing, you will incur penalties, and also get back taxes. So in other words, the tax that you evaded, you will have to pay them. Yeah. Yes. So maybe for someone who don't understand what is an input VAT, when say an input VAT for business purposes, now input VAT is usually the VAT that you pay on supplies or on goods and services that you bought for the purposes of doing business. For example, if you're a manufacturing company and you buy raw materials, when you buy a raw material from the supplier of raw materials, the materials usually have the VAT charge on them. So that one is called input VAT, right? Yeah, so then again, when you talk about input VAT, you should also talk about output VAT. What is output VAT? So output VAT, you as a business now, when now you sell the goods and the goods or services, then you charge VAT on them. So those VAT is what you call output VAT. Like it is VAT on goods and services that you are now selling outward. And goods VAT on goods and services or VAT on raw materials or the goods and services that you use to produce the final good that you are selling is called input VAT. Yeah, so the difference between input VAT or output VAT usually VAT refund or VAT payable. So it's very important to understand that. Yeah, so what about financial impact?
The financial impact of such a case.
That a case, yes.
Incorrect expense recording. If classified under business expenses, it distorts the company's financial records, making it seem like an operational cost when it is not. And another financial impact could be potential cash flow strain. Using companies' funds for personal expenses can reduce working capital available for the actual business needs.
Yes, so let me just expound on that a bit. Anytime you withdraw money from your business or use money or make your company to pay for your personal expenses, it's usually a form of a withdrawing.
True.
Yeah, so how does that one accounted for in how is that one treated in company books? It's supposed to reduce the equity capital, right? Yeah, so that one is supposed to it's not supposed to be an expense to a company. It's supposed to be reduce the equity capital of that particular company. So that is the accurate treatment of such transaction. So anytime you company pays for your expenses, personal expenses, just know that what you are doing in normal sense, you are withdrawing your equity capital. So you are reducing your stake in that particular company.
Okay.
Yeah.
Okay.
Yeah. So that's what that statement means. That you are reducing working capital. Actually, working capital is part of the equity.
True.
Right? Yes. So what about compliance and risk?
Yeah. Under compliance and legal risks, there can be risk of misrepresentation. Recording personal expenses as company expenses may raise compliance concerns with auditors and tax authorities. And there can also be possible director's loan classification. If flagged, the expense might be treated as a director's loan or drawing, meaning the company may need to recognize it as an advance to the audit director, which should be repaid or properly accounted for.
Yeah, so like I told you, so if it's just a small company, like we talk about a private limited company, if you're the promoters, of course you are the directors.
True.
So when you do such a transaction, then we are claiming that you've borrowed loan from your company. Okay. So it is a withdrawal, or we can treat it as a drawing. As a drawing or withdrawal.
I understand.
Yeah, you understand?
Yeah.
Yes. Yeah.
Okay.
Then now, so how to correct this? How should we correct this?
Reimburse the company for the personal expense.
Explain to us.
Okay.
Okay. Can you explain that?
Okay, I do that.
Okay. So So when you say that you reimburse a company for the personal expense, what we mean here, let's say for example, if we treat this one as a a loan to a director or as a drawing. So what you can do, if it's a loan to director, then you should supposed to pay back that loan with some interest, or depending on how we will treat it. And if it is a drawing, then you can take it back as a form of injecting more capital, right, to compensate what we withdraw you. Yeah.
Okay.
Another adjustment.
Adjust accounting records to reflect it as a director's withdrawal instead of a business expense.
Yeah. So
doesn't that sound illegal?
No, it is not illegal, because we are assuming that you withdrew. The only now if you account for it as a director withdrawal, then it means that director withdrawal or withdrawal by director is not going to be a tax deductible. So that is the impact, the legal impact. It's not going to be deducted from the expenses of company. You understand?
Yeah.
So this one will bring what we call temporal differences, right? It will bring temporal tax differences or accounting differences. We usually have tax accounting and business accounting, right? Or company accounting, something like that. So that will bring the difference. Yeah, because a business might treat this one as an expense, okay, to them, to their revenue. But for tax purposes, so tax accounting, we won't treat this one as an expense, right?
Okay.
Yes, but we treat it as a withdrawal. Yes. And next.
Avoid claiming value-added tax input on the transaction to prevent compliance issues.
Yes. So if you do such a thing, don't go ahead by again claiming input VAT. Yeah, because that one will bring problems with tax authorities. So guys, we wanted to inform you about this, so that if you are thinking of opening a company or starting a limited liability company very soon, or if you are in one, it's very important to understand such concepts, so that nobody should lie to you that you just go outside there, spoil yourself, then make your company to pay, then claim that one on tax, or use it as a tax deductible, then pay less tax, use that as a way of avoiding tax. No, that one will be called tax evasion, and you will be forced to pay for that. And you will also attract penalties. So always be vigilant on this. Yeah, so that's all for this episode. Do you have anything else to say?
No.
Okay, so thank you for watching. See you in the next episode.